So hi, Lydia.
Hi, Sarah. How are you?
I'm doing great. Thanks for joining me this afternoon as we're going to talk more about
Forbearance. Thanks for having me. So we were both on a panel this week, which I'm super excited. We're putting it on all different places. And so go ahead and I'm going to let you start first.
Awesome. Okay, because that panel, we're definitely going to talk about it, definitely going to share it, but
Yep.
There's some big takeaways from that. As we dive in this morning, we did get a new update on where we stand with the number of borrowers that are in forbearance nationwide. We actually had a significant drop last week to this week. So that's a big deal. We went down from 6.81% down to 6.32%. That's a really big drop when all the others have been like tenths of a percentage. And what that means is we went down from about 3.4 million borrowers in forbearance to about 3.2 million borrowers in forbearance. So with 200,000 exiting forbearance, it means that there's a number of options: permanent loan modification, refinance, paid out, anything like that. But there's ways that they can exit forbearance. And
Yep.
one of the cool things is one thing, and Lydia and I were just talking about it, to be in forbearance does not mean that you are behind on your mortgages. There are about 25% of people in forbearance are actually current on their mortgage. They just have that as kind of a safety net. Safety net. Thank you. I'm like, you know what I'm saying. So they have it as a safety net, as it's an option where, so they are still making their payments. There's, we'll definitely
Right.
talk about, exit strategies. Some of the things that we're thinking about, there's a lot of, so forbearance is different than it was prior to the pandemic.
Right.
The CARES Act did create some different nuances within forbearance. And some of the things is a lot of that information is changing and is coming out, and Fannie and Freddie are providing new guidance that is different than it was 6 months ago. So that's why this is so important, because it's continuing to change. Now, the CARES Act and the protections provided are going to be expiring soon. So a lot of major economists are talking about, if there is not a follow-up to the CARES Act, we're in trouble. It would really stifle the economy's growth and kind of set us back. It'll take a whole lot longer to get to those pre-pandemic levels and strength of the economy.
Right.
So it's one thing that we're going to be watching is what happens next, and what does that mean for forbearance?
Yep.
Right now, what we know is basically, in order for a borrower to leave forbearance, they have to make 3 consecutive payments and come up with a plan with their servicer or lender on how they'll pay back that forborne amount.
Right.
It's a late amount that was deferred while they were in forbearance. And one of the things that is, because we were talking about it, nothing is free. This is money that does need to be paid back. So one thing that Fannie and Freddie clarified last week with their guidance is that if just because a borrower pays off what was due does not mean that they can go ahead and get a new loan. So if a borrower wants to do a refinance or sell and then purchase again, they still have to have the consecutive timely payments.
Right.
It doesn't matter if they're paying it off. It needs to be consecutive, timely payments. Then they can do a refinance. Then they can buy a new house. That is kind of like, there is no negotiation around that.
Right. And they have to be at least 3, if not longer. They want to see at least 3 minimum. So we Yep.
And then when they exit forbearance, it doesn't mean that they have to sell and not have that house anymore. So another thing that we like to talk about is there are options. Anytime that you have a client or know anybody that is struggling with their payments, they do have options without having to move. So a couple of my favorites that I like to talk about is if they have a 401k, if the borrower has a 401k, there are 2 options that you can use from a 401k. In both cases, they will need to talk to their 401k administrator. But what they can do is they can actually, this has been around forever, they can borrow against their 401k and pay themselves back with interest. And the benefit with this is there's no penalties. You can go ahead, you do it, you pay yourself back, you're great. Now, also, there is a way that you can take a lump sum from your 401k. And through a provision in the CARES Act, it does allow you to take out a lump sum without those penalties. talk to the 401k administrator. But that's a way that you can pull out a lump sum and pay it off and then be done with it.
Right.
There's also options where you can come up with different strategies with the lender or servicer. Maybe they want to do a 2-year payment plan. Maybe they want to add it to the end of the loan. And so there's a lot of different things. So be sure to have those conversations with the lender or the servicer, because there are ways that they can that borrower can stay in the home.
Correct.
If they can't, if there isn't an option, they can move out. Rents have gone up almost as fast as single family or appreciation on properties that they own. That's gone up. So maybe they can move out and rent it and then make up the difference. Or, maybe they can, do a sale and then buy something that's more affordable, or finally sell and rent. And so there's some options there, kind of going in different order depending on what can be a good option for your, the borrowers.
But if they wait too long in the year, so we're trying to get them options now, but if they wait till the end of the year when the timeline is done, because we don't know if they're going to extend it, they need to have a plan in place now before that. Otherwise, they will be trying to dig out of a hole, and we don't want to put them in a hole. So it's better to talk about it now, a few months before the end of the year.
Definitely. Because having that plan, it may take a couple months to get there. So you don't want to be at the end of it, the end of the line, end of it, and being like, okay, now I got to figure something out.
Exactly. Because there's going to be less options then.
Yes. Yeah. And Lydia, why don't you talk a little bit about the panel and one thing, I guess I'm interrupting you and interrupting myself is I will include in the comments 2 resources for borrowers and for renters that they can look into to get more information on these programs.
Yep.
So now I'm going to say, Lydia.
So luckily, Sarah and I, along with one of our lenders and a real estate attorney, was on a panel discussion regarding forbearances. And it was with a company that actually facilitates getting jobs. So they basically, their company is a headhunter. So she connects companies with people that are looking for jobs. So, and a lot of those folks ended up taking forbearance way back in the beginning, because forbearance started, they've always been around. It's basically a loan modification. But when COVID hit, a lot of people that were either let go or put on furlough, or maybe they had to take some time off of work and stay home because their kids weren't going to school. If they got any job or if they got any income loss, they could qualify specifically for forbearance. Now, these were really more for short-term situations. It was never intended to be long-term. The call I was on a couple weeks ago with Freddie Mac, the director of Freddie Mac, what they would like to see, Freddie and Fannie would like to see people get a plan to get out of their, get an exit strategy out of their forbearance. So that gives us a few months to, if we start today, we can get them out of that forbearance. And there's, like Sarah said, lots of different options for you to do that. If one of those options is a permanent loan modification, we've got attorneys, if they don't want to negotiate it themselves, we can bring them in with a real estate attorney that can get the best, because really we want to make it, we don't want to get them into a situation where they've made a worse situation. Like 10, 12 years ago, people were just willy-nilly doing things. And the one thing we have learned about that time when people were doing short sales and foreclosures is let's pre-plan this time. There's equity in most people's homes. There's options right now. So if we can start planning now for the future, for the next couple of months, we can probably get most of those people out of their forbearance time frame between now and the end of the year. The other thing that Freddie said was they are suspending late fees until the end of the year. So that means that if someone's in a forbearance, there's no late fees connected with their servicing forbearance right now, but that doesn't mean that they won't come after January 1st. So we want to really make sure that those people are out of their forbearance at that point.
Exactly. And one of the things to add to that, because it's a little confusing, because the people who are in forbearance are actually, who are delayed on their payments or behind on their payments, are being reported as delinquent. But like Lydia said, it's not hitting their credit now.
Right.
But right now, but it's still being recorded. So that's one of the things. We don't know what's going to happen after January 1st. So it's having a plan.
Right.
Important.
Definitely having a plan. And the reason why I know this specifically is I actually work for a servicing company. And
Yes.
so, you know, when this whole thing hit the last year, we haven't really had a lot of foreclosures, of course, because most
The
people
moratorium.
most people have equity in their home, but nobody can, the lenders and the servicers cannot foreclose on somebody at this point because of the CARES Act and because of the pandemic. That could change after January 1st. And the reason why I know that firsthand is I get a lot of servicing calls requesting to go check on homes. And I believe, my personal opinion, these are homes that are probably higher risk of possibly going into a foreclosure. So they want someone to go take a look at, put the eyes on the home and see if it's still occupied, if it's been maintained, you know, things like that. And so I will tell you that over the last month and a half to 2 months, my jobs have increased just in, this is my pile of jobs that I've done, but just in this last month, these are all, so far, these are all the ones I've done for October, and we're only 2 weeks into it.
And that's over half of that folder.
Yep. So it's picking up, and I'm seeing anywhere from 1 to 5 a day. So that means that there's a lot of people that they're just checking on the properties to make sure that they are still in good condition, but they're probably the higher risk ones is what they're thinking.
And I think that this is really important to mention what you said, because they do have delinquencies at different levels. The 60 and 90-day lates, those are actually the ones that are they're hanging on the books longer. Then we're having a big drop in the newer delinquencies. And so the extreme delinquencies, those are going to be the ones that you're getting those notices on. And one thing Lydia and I want to really, really state here is, no, we're not expecting a flood of foreclosures. We're not expecting a big, horrible storm like we saw 10 years ago, but we know that there is something coming. We don't know to what extent. Yes, appreciation has been 17% this year. I mean, we've got so much stuff that we know is very positive, so it's going to impact a smaller group. We just know it's going to impact a group, and we don't know who it is and to what extent, but everything that we can do to share this information will only reduce that group of people that are impacted negatively.
Right. And just like our panel discussion, Matt was one of our panelists, and what his main focus on was talk to someone now. Let's put a plan together today. Let's not wait till the end of December to try to put a plan together, because some of the plans may take 2 or 3, 4 months to get there. So let's get people to a point where they're out of forbearance, possibly even be able to refinance and maybe take advantage of some of these lower interest rates. But they have to make 3 consecutive payments before they are eligible for refi and or purchase. So we've got to pre-plan this. We need to think 3 months ahead, 3 to 4 months ahead, just to be able to get them to the point where they could talk to a lender and say, okay, I'm ready to refi. So.
Perfect. Yes.
Yep. And we've got, Sarah's got a lot of links. So we'll put the link on our panel on there. And then you also have the link to Freddie and Fannie. So if someone doesn't know who their main investor is, they can go to Freddie website or Fannie website.
I'll put that on there.
Plug in their address, and they'll know which servicer or whether they have a Fannie loan or a Freddie loan.
Perfect.
So
just made a note of it. Awesome.
Well, thanks, Sarah, for helping us get some updates on forbearances, and let's keep people in their home. You and I are both in the business of home ownership. So let's try to keep people in their home. If they have to temporarily sell it to move into something else and then regroup, we can help with that as well.
Perfect. I think it sounds great. And I appreciate you and all of your time, Lydia, and anybody watching. Thank you, because all the information we can get out there is good.
Yes. So let your friends and family know, and I'll see you next week, Sarah.
Sounds good. Thanks, Lydia. I'll see you later.
Thank you. Take care.
Bye.